Hey there, traders. Todd here. Welcome to the Wednesday ENCORE presentation of Trading the Volatility Wave. I'm Todd Gordon, and let's see, almost set up. We're good, almost on time. Sorry for the typical 2 to 3 minute late start time here, but let me just get in and make sure the sound is okay. So I'm just going to go in and check that we're good, and then we will get rolling. We got a good presentation here for you. I'll bring in my good friend, Terry Long. Everybody good? Sounds okay? You guys are strolling in? Okay, perfect. Yeah, there we go. Terry's saying, where is everyone dialed in from around the world? There we go. We have Singapore to start, and Michigan and Illinois. We have a few people coming in here. So guys, this is an encore presentation of the presentation we did last week. We had a few tech issues that didn't allow us to give the best presentation, but yeah, we had really good demand for the presentation and also the offer that we're going to make after. It's just simply a way to continue on if you'd like to check out what we have to offer. So it's going to be a lot of content. I love the interactivity, and the only way I could do this properly is with this fine gentleman right here, Mr. Terry Long. Sir, good evening. How are you?
Hey, Todd. How you doing?
Good, good.
You know, I got a slave driver of a boss. You know, he just works me from dawn till dusk and until burn the midnight oil. And
we had our typical Wednesday live stream at 8:45 this morning. Terry checked in at 8:30. It's now 8:04 p.m. I appreciate your dedication, sir. I really do.
Absolutely, absolutely.
So Terry's this. What's your title this week? He's the jack of all trades. He's wonderful at our style of analysis. Wonderful at trading, investing. He's our senior technical advisor. So he's going to join me on the webinar.
Yeah, that's good enough.
Kind of keep me on track when I get off. You know, when I venture off track. So we'll have some fun. Let me get the questions up, and also. Terry, yell at me if somebody has a question, comment, insult over there, because it is just off the screen. Okay.
Right. We'll try to field. I see some members out there too. We got some of our new members in this crowd.
We do. Members of Trading Analysis, right on. How's everyone doing tonight? How's everyone? Busy market, soon to be, possibly. Everyone good? Trading's good? Happy Wednesday.
That's what it's all about here. We're going to learn tonight how to ride through this volatility wave.
That's it.
I mean, that was like it couldn't be a more perfect title to your presentation in these times, Todd.
Right.
I'm just, you know.
And as we'll show in in here in the first couple slides, I'm not trying to be alarmist. I genuinely believe we're going to see an escalation of volatility, which means, your trading approach needs to be dialed in, because what we've seen over the last 3 to 5 years, I do not think will continue going forward. So you really need to be focused and have a good understanding of your approach, what you're trying to do in the markets, your process, your execution, your risk management. And everyone says that, but I genuinely believe that's something that you need to be focused on, because I don't think
volatility is not something to be feared if you have a good trading plan and you remain disciplined to your approach. The volatility is actually much better. It's for trading when we can actually see what's happening in the markets. So.
Yeah. And let me just introduce Terry quickly. I don't think I have a proper slide. Terry is a former engineer at ExxonMobil. He is a very intelligent guy. He was a former customer of Trading Analysis. He knew our stuff at times better than I did. So I asked him if he would.
Good teacher.
I asked him if he'd work with us, and he's excellent. So he's going to be assisting us here and just kind of moderating, and as I say, keeping us on track. Highly qualified. Alex is overseas. It's middle of the night, so we didn't want to make him be here. My other team is
like 2 a.m. It's 2 a.m. where he's at. We want him to get a good night's sleep. Crypto markets are extremely volatile. We want him to be fresh on top of this tomorrow.
That's right. All right, guys, let's jump in here. I always have some form. Those of you who's been here to a webinar before with trading analysis and me recently, I always have some twist of this slide, but tonight's different, not unlike most times, which I usually put a new twist on this. And Terry, I might trip you up on this one. So Revolutionary War trivia. This battle, known as the turning point of the Revolutionary War, lasted from September 19th to October 17th, 1777. We're right in the middle, right in the midst of this famous battle, I think 243 years ago. What battle was that? Those of you who've been with me for a while know what this is, but type it in the YouTube box. I want to know what famous battle we're in the middle of, but 243 years later. And there's about a 30-second delay on YouTube. I forgot, so I'm gonna push on. That is the Battle of Saratoga, and that's where we're coming from right now. So it actually started on the 19th, and that's why we have our freedom today. This was the turning point. So, guys, we're going to talk a little bit about a lot about trading. We are real traders. We put our real capital on the line. We always have you focus on the risk that's in front of you in every single trade. You got to focus on the risk in each individual trade, how it pertains and impacts your individual account. We talk about position sizing. We trade live based on every kind of trade alert that we send out to our members or investment that we make in the portfolio. I put on myself. I have the exact same trade. Within a couple pennies for execution, I have the exact same trade on, and I accept the risk that goes into every trade. We make money, we lose money. We're never going to sit here and tell you I'm going to triple your account next quarter. That's not the way we operate. I have way too much respect for this business to try to pull that kind of stunt that unfortunately other people do in this industry. So I take it really seriously. Don't trade with money you can't afford to lose. Past performance is not indicative of future results. Anything can happen here. We're literally trying to forecast the future. So are we all cool with that? Anything I left out, but there is a disclaimer. Okay, so there's the team, trading analysis team. Terry's on the line with us. The rest of the team here works very hard to bring the product to market. One of these people on this slide is my mother, and I'm in the accounting department. And I'm sure you can pick her out. Just a little bit about me if you don't know who I am. Obviously, I'm a goofball. I do this job because I love it. I have fun with it. I work very hard at it. I'm an entrepreneur. I'm a father. I'm a trader. Founder of Trading Analysis, CNBC contributor. I've been doing it for 10 years now under contract. I'm actually coming up on my 4th 3-year contract if I get renewed in January. I was a Division I ski racer in upstate New York in school. Started trading right out of college in San Diego, moved back east. I traded for a hedge fund on Wall Street, was senior technical analyst at a big firm on the street, and left in 2010 to go out on my own, and here we are in 2019. Those are my boys, Jake and Brody.
Wow. You'll be coming up on your 10th anniversary next year.
Yeah, and I'm 40. Time goes like that. So just some. Yeah, my poor little guy. We had our first. This was this weekend. You can see the date, 9/22/19. Broke his arm and wrist, falling off the monkey bars. Not really happy. He hated his black sling and cast. But as soon as he figured out he could choose his own color for a cast, he was kind of happy. So he's good. He's fine. He's one of my twin boys and then a baby girl. So that's a little bit about what I do. I'm a trader. I'm an analyst. Proud family man. And sometimes I go on TV and flap my gums. So that's the company, tradinganalysis.com. That's who we are. And this is a little bit about what we provide. So what we'll cover tonight here, guys, is the 3 major parts of how we approach the markets every single day. Fundamental and intermarket catalysts driving these markets. Obviously, we specialize in the technical analysis of these markets. Once we have an idea of what the fundamental news is that is kind of circulating, which you certainly know there's a lot of fundamental and political and geopolitical news kind of being circulated here over the last couple months, and what is actually impacting the markets and what's actually shaping price trends. From there, we put that all through the sausage grinder of technical analysis, and out the other end is hopefully a refined product and an actionable trade. We prefer to get our market context through the lens of Elliott wave, which is more complex than most are used to or perhaps comfortable, in terms of a form of analysis, more than comfortable to accept or to put the work in. We love to work hard at this. It's a great intellectual pursuit. It'll put you in front of turning points and trend continuation patterns that I don't think you could see with any other methodology. So we'll talk about that. Part 3, we'll look at how we put the trade to work, whether it's in the stock market or the option market or however we put it on a crypto trade. Or we are in Saratoga, so maybe if it's a terrible market, maybe we'll go to the horse track here and try to hit the daily double and the 9th and 10th race. No, I'm just kidding. The markets we trade, so we're going to talk about, obviously the exact setups that we trade, and I'll show you a couple live trades that we have on right now. Finally, introduce you to tradinganalysis.com. Some of you, I think, are watching on the YouTube page. Some of you are watching on the Trading Analysis page, and you'll see that obviously there's going to be an offer below if you'd like to continue on with us. Don't worry about that stuff right now. Just focus on hopefully the presentation. I'm going to try to get you out of here in about 45 minutes and get it done, okay? And then we can kind of show you, if you'd like to continue on with us, what's going to happen. We have a lot of good content to show you tonight. So, a lot of good. You will certainly derive value. I don't know what's going on with this stuff. So you will hopefully take a few things away from tonight's presentation. It'll give you value in your trading. So let's jump in. And if you guys want me to increase the screen size, I will once we start getting some charts up. Is it okay right now? Tell me if it's okay with the size. Well, we have some text and kind of fluff in the beginning. And once we jump in, I'll actually have to push Terry out. Unfortunately, man, I love you.
Yep. I love it.
How am I doing so far? Pick it up? Boring? Keep going?
Let's get to the good stuff.
Yes, sir. So we just saw the lowest realized volatility, okay, in 100 years. Volatility, guys, is just up and down price action. It's not trending up. It can be viewed as trending down, but for the most part, up and down range is viewed as volatility. We just saw the lowest volatility in a century. And in fact, it's 114 years looking at the Dow. This is crazy. This is absolutely crazy. This is the Dow from 1905, and what's awesome is one of the charting softwares that we use is Thinkorswim. And this is a charting software that everybody has access to. You have a chart with them, and they've got Dow Jones back to 1905. And what we'll do is introduce you to this indicator, and I'm going to take it off full screen here in a second, and I'll come back to Terry. And Terry, I'm going to keep you live if there's anything you want to hit me with, I've got you on Slack, and I can just bring you in real quick. And if anything I left out or you want to add, just please let me know, okay?
Yeah, we're good. We're good. Move on.
Okay, got it. Thanks. So what we're doing here is looking at the APTR. So this is average percent true range. And don't worry, I'll make this bigger here. This is looking at the average true range, which some of you should know, which is just basically high to low movement over a certain amount of periods. The more movement you're seeing is in the greater range that's experienced between the high price and low price within whatever period we're studying. I think that it's better to normalize it by looking at not, if it's 50 points on average per day in the Dow, look at it in terms of percent. So therefore you can compare a 27,000 Dow to a 500 Dow way back in the early 1900s. So if you go to the APTR study, which is average percent true range, there are some significant very low percent realized range here on the monthly chart. Each one of these squished up bars represents 1 month of trading. And what we're doing is basically figuring out the high to low range on a percent basis and looking at it over the last 114 years. So let's just go through history here a little bit and figure out where exactly we are. And I've already told you it's the lowest volatility in over a century. So let's look back in 1914, 4.7% range. 1954, 4.59%. 1965, the Beatles have been in America for 1 year, 4.65%. Fast forward all the way just before the 2007 credit crisis, very low range, 4.7%, and then look what happened. Oh. So here we go. This was December of 2017. We just saw a 4.55% averaged realized percent change volatility over the last 21 months. It's the lowest APTR since 1905, and in fact on record. So what does that all mean if we have really low realized volatility? It means get ready for mean reversion. Okay, get ready for a return to volatility. And if I go back to this APTR chart, like, would it be obnoxious to say we might get to 6, 7, 8% range per month on the Dow? I don't think so. And that just means more of this back and forth and this back and forth. And you can't see it here because the range is completely lost, because this chart would have to be about 4 computer monitors tall to get you the true range. But we will see a return to volatility. And the point is, if you're not ready for this, if you're trying to approach the market, which is just buy and hold in a super low volatility environment, realized vol environment, it's going to change. It's going to change, and you're going to have a hard time going forward. So that's what we're talking about tonight. So as I've said, there's 3 approaches to my trading. So I always look at the fundamentals and what the macro kind of flows are. I always want to know what the big boys are talking about. I want to know what news stories, the fundamental news media and the financial media is trying to disseminate, whatever they're trying to sell in terms of, whatever the most important story is that will get clicks and advertisements. I want to know what people think is actually driving the market. Now, and I'm skipping ahead here, what should be happening in the economy according to current news cycle and economic theory. A lot of people, unfortunately, the misguided masses think that whatever news story is happening today is causing the market movement. I hope you realize that's just not the case. The financial markets discount 3, 6, 9, 12, 18 months into the future the news that is happening today. Now, there's some events that are completely out of the blue that will move the markets on the short term, but financial markets are very, very intelligent, and they do discount future news events well ahead of time. So I want to know what people think are moving the markets based on whatever news cycle or news flow is happening right now, and then filter it through the lens of technicals and intermarket analysis to see what's actually happening at the hard right edge of the chart, which I guess that's your right on the computer screen, my left, right? And finally, capital deployment and asymmetric risk-reward setups. When we are aware of what the fundamental news flow is and what people think's driving the market, then we can look ahead through the lens of technicals and filter what's actually happening in the markets, whether it's in agreement with what the fundamental crowd is saying, whether it's in disagreement, whether the story's played out. We can then define our risk and define a reward using technicals, and then put our capital to work in an appropriate market. That's your 3 steps to trading. Know what's being talked about and what they think's driving the market, figure out what's actually happening in the market, and then make a trade based on that void, okay, that difference. Okay, so number 1, fundamental intermarket catalysts driving these markets. All right, so let's just kind of talk about the Fed cutting with interest rates at all-time, or it's Fed cutting with stocks at all-time highs. We have not yet made a new high. 3026 is the all-time high. We closed the S&P really close to it. Where did we close S&P today? It was within certainly a stone's throw here. Let's just take a look at the live charts. S&P was 2984. We went up to 3021 before we broke down over the last couple days. So ultimately, what's the Fed doing? Cutting interest rates, which is normally reserved for a time when the economy's in trouble, stocks are falling, we have deflationary forces pushing the Fed to try to stem those and try to generate some activity in the economy. So what does it all mean? Right now, we just cut interest rates on September 19th down to 1.75 to 2%. The next Fed meeting is October 30th. And what I find very interesting is right now we're at a 53% chance of cutting another 25 basis points. 25 basis points means 0.25%. What's interesting is 1 week ago, if you guys can see this, which I don't think you can, it looks like it's cutting it off a little bit. Let me just kind of do this and hopefully it doesn't wreck the presentation. I don't know why it's so small. I'm just going to pull this up and then I'm going to go present. Okay, so you can see that 1 week ago, the probability of dropping 25 basis points was only 28.2%. Yesterday, it went up to 64%. There was almost a 3x, there was a 3x increase in the probability of a Fed rate cut with the markets at all-time highs. There's obviously external forces beyond just equity prices that are causing the Fed to cut rates. I think it's the political news cycle, news that Pelosi initiated an impeachment inquiry, and that kind of shot things up very quickly. So right now, we backed off from a 64% chance of a rate cut down to 53. The stock market had a nice day today, despite everything that was happening. So we're at 50-50 odds. So beyond the political front, what's happening that would cause the Fed to cut rates, which again is reserved in times when stocks are falling and they're trying to stimulate the economy. The big part here is the PCE deflator. This is going to be the Fed's preferred gauge of inflation is bouncing off this 2% mark here. It can't get above a sustained 2% over the last 7 years. The Fed is comfortable with inflation at that 2% target. Tried once, tried twice, and has failed. Ex-food and energy, it's failed miserably. Trim PCE mean inflation, which is the headline reading, is still comfortably below 2. So without inflation, the Fed is free to cut rates. And the theory is if inflation is not a problem, they can cut interest rates, which causes people to borrow money. I just refinanced my house at a ridiculously low rate, buy a car, buy a boat, reinvest in your business, borrow money to do stock buybacks, anything that might happen. So part of it's inflation. And the other part is where global interest rates are. Our interest rates are well ahead of the rest of the world. Okay. The green up here is the US yield. The red is the UK yields, blue, Germany, orange, Japan. What's happened is our interest rates, our yield on the 10-year bond has been rallying all the way from 1.5 to 3.25, while the rest of the world just went sideways. And we got so far ahead of the rest of the world, we're trying to raise rates. Trump came in trying to campaign on higher rates, normalizing rates, get him to a normally functioning economy. Then he saw that higher interest rates isn't necessarily good for the stock market, didn't like what it did for the approval numbers, and switched his story very quickly there. And plus, we're getting so far ahead of the rest of the world, which that can lead to currency stresses. If our interest rates are higher than the rest of the world, people are going to sell foreign currency, buy the U.S. to buy U.S. investments, which strengthens the dollar, which if you look at your intermarket analysis, is not a good thing. So it's hard for our interest rates to go up faster than the rest of the world. That divergence is being unwound, okay? And that's why we've seen a massive drop in U.S. yields, and the Fed cutting interest rates is part of that. So next time you're at a cocktail party, how are we doing so far, Terry?
Very entertaining.
Are you laughing at me or with me?
With you, absolutely.
Yeah. So next time you're at a cocktail party, Terry knows
I want to say something about that last slide that you had, not the frogs, but the one, with the U.S. economy being outpacing most of the other economies, that's the problem that's set things in motion. So interest rate differential, get a higher interest rate in the States, the money is not going to be invested in the foreign countries. It's just coming to the States, right? So getting their trade out of balance too. So, today it's a global economy. Okay. We can no longer work independently like we did 50 years ago. and drive our own economies independent of the rest of the world. Today, everything is so closely knit that I guess, what we're seeing here is that the raising the rates was too fast, and it was probably with some old paradigms in mind. So that's my 2 cents.
It is a challenge because U.S. companies, they are making good money. The innovation is, I hate to say, the innovation is basically here, and there's a lot of flows coming into this country. But as Terry said, we are a global economy now, and we can't, our valuations and our interest rates, can't be that much further ahead without, some inverse negative implications, and that right. Unwind is happening now. So, right. So let's keep going. So next time you're at a cocktail party, you can impress some people and try this. Ask people, like, what's their traditional relationship between stocks and bonds? And I bet you at least 61.8% of the room would say they trade opposite each other. Stocks up, bonds down. Well, if you look at this, I love this chart. This is probably my favorite chart in all of our business. Is this dates back to 1979, 40 years ago. And you can see that the S&P in red on the left scale and the 30-year bond, this is the price of the 30-year treasury on the right. I would say on the whole, if you look at a 20-period rolling correlation, on the whole, it's mostly positive, up to 2000. Now, there's only two times when there's strong inverse correlation, meaning stocks up, bonds down, or stocks down, bonds up. That was the tech crash and the real estate crash, okay? Those are the only times that bonds actually got a bid when stocks were selling off. The rest of the time, bonds just go up. And remember, I'll show you the next slide. These bond prices go up, the yields, the interest rates go down. Those bond interest rates have impact on mortgage rates, on whatever loan you want to take from a bank. They're going to set those. Your credit card, your mortgage, I'm believing on other interest rates that we come in contact with day to day. But what's interesting here is we've seen a return to negative correlation temporarily. It's the first time in 40 years that we've seen a little bit of negative correlation on a 20-quarter, so I guess that'd be a five-year basis, negative correlation without stocks going down. Stocks went down a little bit in December and January. That's it right there. Not much in the grand scheme of a 40-year rally. So it's interesting. The Fed tried to raise rates, which makes bonds go down. It didn't work, clearly. Trump was threatening to fire Powell every week. And our stock market reflected the increase of interest rates, sell-off in bonds. So I think this normal return of positive bonds, positive stocks will come back. So we tried this experiment of raising rates and it didn't work well. It's our second version of a taper tantrum, if you remember that. We've had two in about 8 years. So I think the bonds and stocks will start to trade together, and I think interest rates will continue to go down. So try that next time you're at a cocktail party. And this is just Terry, I'm going to flip this off here. And you know what? Let me do this, Terry. I'm going to leave you in for 1 sec. Take a breather for 1 second, Terry, Alex. Okay, there you go. You're in now. There we go. So this is just a reminder, guys, to show you that the price of the bond in white goes up, yields go down. They just trade inverse. Everybody cool with that? Scott says something very important. I recommend some of John Murphy's work and intermarket analysis. I couldn't agree more. I talked about his book last week on the Wednesday live stream that we do at 8:45. You ready for this, Scott? I hope you're sitting down. I still have the book on my desk. Love this book. So good. Everybody should read this book. It literally changed my career. It pulled a lot of a few of my main kind of components of my analysis together for me. Love that book. Intermarket Analysis from John Murphy. Read it. Okay, so let's take a look at this. This is kind of fun. I mentioned that as falling bond yields or increasing bond yields will have an impact on an interest rate that I think a lot of us are come across every single day, which is the 30-year mortgage rate. So the yield on the 10-year bond, remember, bonds up, yields down. What's up, boys? Everything's good. Bonds up, yields down. Yields down will have an impact on where mortgage rates go, specifically the 10-year note. So what was happening is I was trying to refinance. I bought my house here in Saratoga a year ago. I was at 4.62 and a 30, which is expensive compared to where it's been. But I was using Elliott to kind of time where the bond market was going to refinance. The 30-year bond and the 10-year note were moving up as the yields were moving down, but the 30-year mortgage rate was actually moving up and not going down. So I felt like Michael Burry in The Big Short when he was short mortgage bonds via CDSs, collateralized debt, or the swaps, I should say. And the banks weren't marking the swaps correctly, even though the mortgage bonds were disintegrating. The banks were positioning to get short themselves. So I was like, come on, banks, let's go. Let's move the interest rate. So finally they moved, and I did refinance at 3.37 with TD, which was pretty good. But it's all within this bond market. That's why I think this move that we've seen in 2019 in bonds is so important. And if you're a stock trader, I think the key to this market is knowing what interest rates are doing, and specifically knowing whether it's risk on or risk off in the overall stock market, but also sector selection. There's a lot of sector rotation that's happening right now. We've seen a big shift, as we'll talk about here in coming slides, about moved away from growth and into value, like staples and real estate and utilities, and away from discretionary and technology and stuff like that. So, this is the outlook that we're trading in bonds, and I have an option position on right now that is designed to take advantage of this specific trade. So let me see if I can just find it. So I think we're going sideways here. I think we're going sideways into the end of the year in bonds and a big old fourth wave triangle. So I have a little call butterfly, and if you're new to this, I'll come back and revisit it. I don't have the one thing I didn't do is get my TD up, but that'll launch in a second. I'll come back to that. I'll bring that up when we do the options section. Terry, will you just remind me on that one?
Okay.
Okay, thanks. That's awesome. Okay, Michael, so briefly explain why bonds and rates move inversely. All right, let me just do that quickly. I think it's important, all right? A bond pays a $100 coupon payment, right? It's always going to pay $100, but the price of the bond trades just like a stock, right? So if you have a $1,000 bond and it pays $100 a year, it pays 10%. But if you put that bond out on the market and trade it on the Chicago Merc, and the bond price goes up to $1,010, $1,020, $1,030, but it still pays 100, what's the interest rate? What's 100 as a percent of 1,020, 1,050, 1,100? That interest rate goes down, right? So if it goes from $1,000 to $1,100, but still pays $100, what's 100 as a percent of 1,100? It's less than 10%. Conversely, if the bond price goes from 1,000 down to 900 to 800 to 700, the bond's being sold, but it still pays $100 a year coupon payment. 100 as a percent of 900 is more than 10%. Got it? Does that make sense?
Great answer, Todd.
Okay.
That's much better. I was trying to think how to explain it, but you did it much better.
Okay, cool. Thanks. Let me know, Michael, and I'll spend more time on that after I get through. We're trying to get you guys out of here, and I just love to talk too much. So I'll hit that again if you'd like help with that. All right, so that's that. I'll come back to the option trade that I have on. I got to launch my Thinkorswim, my live platform here. No big deal. I'll come back to the actual option trade once we talk about options. Okay, so let me just do that. Copy, and I'll just get this guy fired up. All right, that's working in the background. Thank God for a lot of RAM. All right, so live TLT trade with broken wing butterfly for wave 4, which is kind of funny, like a broken wing, like my kid in the cast. In fact, it did just come up. I'll give you a quick little taste. I have this in my TLT, my IRA, I should say. Analyze TLT.
You got to bring it on the screen, Todd. It's not showing.
Oh, okay. The screen is actually frozen.
bond prices.
Yeah, it's frozen. I was noticing that.
And now it went black.
Yep, saw that. Okay. Weird. Okay, so yeah, sorry about that. I was kind of noticing, but we should be off. We should be back on now. So this is the butterfly trade. Let me go back to the chart. Here's the actual bond price. This is the chart. You guys should be able to see it now. It's a Elliott triangle, which we'll talk about. It's a sideways consolidation. And there's a way you can trade with options where you can take advantage of option decay just within what you anticipate to be the corrective zone. So the way we do this is with option butterflies, and this is the actual live position that I have on right now, centered around in the TLT, which is your bond ETF, centered around 142. All right, so here's the actual trade, centered around 142. I'm short 10 contracts there, long 139s and 144 halves. This trade I can lose 325 max, but I can make 1,200 on the upside as well. And I'll talk more about that as we get through the presentation. Okay, so let me just take a look here. Did I lose this desktop capture? Let me do this. Go back over here. Terry, I'm going to lose you for 1 sec, and I will come back. Okay, I think we're good. So here is the yield curve. Okay, people have been talking about the yield curve for a while, and I think it is important that you understand, what it means and kind of what impact it'll have on your stock market positions. Generally, what happens is when you have yield curve inversion, it means the stock market's in trouble. And without getting too much into a lesson here, a fundamental lesson. There we go. What happens, guys, is if there's interest rates all along what they call the yield curve. There's short term 3 months, there's 2 years, there's 5 years, there's 10s, there's 30s. If the short term gets too high and higher than the longer interest rates, that's bad for the economy. And that's what's called yield curve inversion. And again, I don't mind answering more questions on that, but let me get through the majority of the content and we can come back. So the black line here over the last 30 years is where we've seen yield curve inversion. Back in 89, back in 2000, and here we go again back in 2019. We also saw it here in 2007. So two of the last 3 yield curve inversions resulted in a pretty good stock sell-off, 2000 and 2008. We haven't yet seen it here. We also didn't really see much of it back in 1989. So the last 2 saw a stock market sell-off. 3 yield curve inversion events ago, we didn't see a stock market sell-off. So does it mean we're going to sell the stock market immediately? No. There's actually like a 2-year lag for yield curve inversion, stocks start to sell off. So if you've heard people on TV talking about this and they say, oh, it's a bearish sign, sell stocks. Hold on. Usually it takes about 18 to 24 months for this to begin to materialize. And it doesn't always mean the stock market sells off. Could be like back here in 1989. So if you look at these yields, one market that I really like to look at with these yields, because bonds are a good indication of whether we're going to have increasing price levels known as inflation or decreasing price levels known as deflation. So if you look at the overlay here of crude and yields, this is key. Crude oil tracks yields because both trade with inflation or deflation. So what we've seen is a very reliable correlation of crude and yields over the last 12 years. Crude sells off in the credit crisis, so do yields. Yields go down, remember, bonds go up. If the credit crisis is happening, stocks are being sold off, crude oil is being sold off because of decreased demand, and you're seeing yields start to follow. So then we see yields move up, and then we saw yields drop. So we saw crude yields go. We saw yields make a new low with RSI divergence. Crude oil didn't do anything. They rejoined, sold off again in 13 and 14. Both made a lower low, but we saw RSI divergence again studying the yields. I'm wondering if we're seeing the same thing happen again. Would we see a new low in yields with RSI divergence, and perhaps crude oil is going to do what it did back here in 2011 and 12, which is just go sideways. The point of me talking about all this stuff, I'm not trying to sound smart and fundamental. The wave count that I have in the crude oil market, which I'm happy to show you, is this. It's a triangle. It goes sideways. And we have precedent. We've got an occurrence of yields making a new low, crude not confirming by following lower, because you can clearly see the two trade together. So I'm wondering if we see a new push lower in yields, RSI divergence, and crude oil just goes sideways like it did back in 2012. And that would certainly match up with the wave count that I have. So this is one of the key factors that I use to help simplify and make Elliott wave less subjective, okay, make it more objective by looking at correlated markets that help me kind of understand where, you know, my chosen market might go. Also, as I mentioned, sector rotation is very important, okay? As yields are dropping, as bonds are being bought right now, markets and investors are going towards dividend and more kind of value names like consumer staples. So this is the consumer staples acting very strong, like that's a defensive sector. Why? Well, if yields are dropping, people can't make any kind of return in the bond market because, you know, what they pay is going down. They have to pay too much for the bond compared to what you can make on the coupon payment. They're going to run into the safety and the dividends that are given to you by consumer staples. And you can see consumer staples S&P 500 ratio is clearly moving up. Sector rotation again, utilities into the S&P 500, or what we like to call a UTS. What's a UT? Remember that one? So we're seeing the same thing. Utilities are making new highs because, again, they're not growth stocks. They're not going to be like breakout, you know, 80 PE stocks. You know, they're going to be dividend paying safe stocks, and that's why we're seeing a bid for them, is because you're getting dropping interest rates. You're seeing yield curve inversion. The markets are becoming afraid. So that's why we're seeing a move into these more defensive sectors. Whether it continues and you want to shift your portfolio, or you just want to be aware and think it's a short-term overreaction to bonds, you know, we have to make that decision, but I think it's important to know why it's happening. Okay, we are seeing a shift, as I just mentioned, out of growth into value. This is iShares growth into value ETF. Looking at the technical support, I think we have room to go lower. So this is a little bit of fluff here, guys. I'm a little behind. I've got too much information, as I normally do, talking about just kind of preparing for your trade. Inspecting the course. Knowing what obstacles lie in front of you before you jump in a ski race doing 50, 60 miles an hour. That was me about 35 pounds ago and 20 years ago in college. Inspecting a course before you jump in is really just like a trade or investment. There's a lot of things that you can know. You can build a game plan before, and this is actual an inspection process before a ski race. Guys side slip down, they go very slow, they make mental notes, they make a plan of attack. And then once they're in the course doing 50 miles an hour, you got to be operating on your game plan and being able to be free to adjust for things that couldn't be known or variables that pop up. Trading's the same way. And I look at technicals the exact same way with Elliott Wave. Okay, Elliott is my way to prepare and look down the ski course and say, here's where the next turn's going to be. I need to be aware of that snow condition. I need to look at the pitch. The snow is in the sun all day, so there's a lot of moisture, and it's going to slow your skis down. Like a lot of things you can know ahead of time. So it's about formulating a game plan and getting context. There's only two ways a markets trade, right? Either in a directional manner or a correctional manner. Either you're breaking out of jail and you're trying to go, or you're locked up, baby, and you're not going anywhere. So how many of you guys in the room are using Elliott? Are you comfortable with it? Are you, do you know enough to be dangerous? Do you think it's voodoo? Michael, what? You live in Saratoga? Well, come on over, man. We got guys hanging out. Come on over. Hang out with us. I will. I'll show my short-term count, Miguel. Yep. How many guys are using Elliott? But let me know, and we'll push through. So there's two kinds of ways a market can trade on a directional basis, right? Either in a motive impulse or a diagonal. I'm going to go a little fast through here because I'm not going to be able to teach you in the short time that we have Elliott Wave, but I just want to remind you, if you're comfortable with it, there's two ways that a market will trend, impulse or diagonal. The impulse waves are usually waves 1, 3, and 5. Okay, now depending on where you are, you'd either see, as I mentioned, an impulse or a diagonal, but those are the two ways that the markets will push forward. And if you can identify which wave you're in, you'll have context to know, are we just in the beginning of a trend? Are you in the middle part, the most healthy part of a trend, or are you in the final stages of a trend? The other way a market can trade through the lens of Elliott is in a corrective situation, which is just simply correcting the prior trend that's in place. There's only 3 kinds of corrections: a flat, a zigzag, and a triangle. This is prevalent right now. Triangles are happening all over the place, and there's specific option strategies that you can use to take advantage of that sideways movement. I showed you the TLT butterfly. We have a Nike butterfly that's on right now for earnings that came out yesterday. We have one in CarMax. We have a lot of butterflies because we are in very sideways markets right now. The S&P outlook. I think we are in a big triangle that could last into next year. So it could be sideways. It could be more of this non-movement for another year, guys. And that's just the context that's afforded to us through our work in Elliott that we share with our clients. If you're scared about technicals, please don't be. It's just simply traditional patterns given specific values and expected starting and stopping points based on the Elliott wave theory. Patterns you guys know: triangles, head and shoulders, parallel channels, flags, wedges, blah, blah, blah. It all is explained via Elliott. So again, there's the S&P. I think we're in some kind of 4th wave correction. There's several patterns that are expected in wave 4 before we eventually go up and make a new high. I was on CNBC's Fast Money last week, and I was doing this Elliott wave chart. And I told Melissa Lee, I said, the upside target, once this correction's over, depending on the angle of ascent, is 3,500, 3,800 in the S&P. And she goes, "Oh, Todd." She's like, "What?" She's like, "You're the most bullish guy in the street." It's not bullish guy in the street. I mean, look at a chart. Look at where the correction is. Look at where the upside resistance is. 38, 4,000. I don't think that's a problem. Okay, so this is the kind of environment we live in, and you have to adjust your trades accordingly. Okay, this is the short-term look. I do think we have a continued 5-wave move up. There will be a pretty good test of resistance into the 31 to 3,200 zone in the S&P, and you need to be prepared. All right, part 3, our preferred trading vehicles, the markets we trade to capitalize on the coming market vol. Okay, we're not trying, we like to trade options, we like to trade stocks. We don't trade options trying to bag the big elephant, buy an option for 50 cents out of the money and sell it for $5. That's just not a good way to do it. You will lose your money slowly but steadily over a pretty short period of time. Okay, we're trying to get a little bit more steady, conservative growth through the proper use of options. So we like to do debit spreads. Debit spread is buying an option where you see support might be and selling an option where you might see resistance. Okay, risk is capped, but so is reward. It's one of the easiest ways to start trading options. And your theta, which is the melt or decay that happens with options, is minimized because you're long an option and short an option. And the ice is kind of melting below your feet without that spread on. So just a simple example in Intel, if you think we're going from 50 to 55, why not buy the 50 call, sell the 55 call? A call debit spread is simply buying the 50 call for $228 and selling the 55 for $38. So your net outlay would be $190. Option prices are quoted like this, so it's 2.28 per share. So you multiply it by 100 for 100 shares. So you pay $228 for the option contract times 100. Selling the 55 call for 38 cents or $38. Your net outlay is $1.90, and you know exactly where you think the market's going to find support and where it's going to find resistance. All right, let me zoom in on this screen here a little bit. The same thing can be done with puts. All right, puts. let's go a little closer. If you think the market's going to decline, you can do a put spread. All right, and this is a mistake. It should say puts here, not calls. But buying a $119 put in the TLT is a bearish expression. Selling the 115 is your downside target. You know, if you have resistance up here and anticipated Elliott support down here, why not try to capture that zone? This 89 cents or $89 per put spread is all you can risk in this particular trade. The max profit would be the distance of these two options, okay, which would be $400 minus the $89 you pay to get in, would leave you $3.11 of profit that you can make. So you're risking 89 to make 311. That's what buying this put and selling this put will give to you. That's a solid reward to risk ratio. Okay. Credit spreads. Rather than buying an option close to the market, you can sell an option. Okay, you can sell an option and buy a higher one for a credit. Okay, I'm going to skip this one. We're kind of getting beyond the kind of scope of what we're trying to do here. But just quickly, if you want to be bearish on a market, you could do a put spread as I just showed you, but you could also short a call, which is a bearish expression as well. Buy a higher call, which creates your capped risk, and collect the premium between the two. And there's specific times that you'd want to do that. But again, we're running a little bit behind schedule, so I want to push forward here. But just another example, if you want to be bullish on Apple, rather than buying calls or buying call spreads, you could sell the 115 put and buy a lower one, which would cost less than what you sold the 115 for. The net result would be a credit that goes in your pocket right away, and that's your max profit on the trade. So an option trade that we like to do a lot of, specifically in range-bound markets, are the butterflies. Okay, the butterflies are basically a combination of a call spread and a put spread. Okay, it's long a debit spread and also short a credit spread. You can do it with puts, you can do it with calls. It's combining these two options. And if you're new to options, I promise this is going to be confusing. Do not feel left out. This is very rushed. I'm just giving you a taste of what we do here at Trading Analysis and what we can teach you. Okay, so basically what we're trying to do with a spread, and let me just take a minute here. Let me get off of this, and let me just look at you for a second here. A butterfly, right? Are you guys okay with the idea of a call spread, right? If you think the market's going to go from here up to resistance, from support to resistance, you could buy a call down here, sell a call up there. That's going to be a debit to your account. If you think this is as high as the market's going to go, you could sell, let's say, another call on top of that, but buy a higher call, which will result in a net credit. So the credit that you receive for that call, this call spread up top, can be applied to the debit that you purchased down there, which would reduce the amount you have to pay. So what you want is the market to move up to that zone, but not through that zone, because the debit spread is going to be financed by the sale of the credit spread above. So the idea is like have a plan, have an idea, have context that you think the market's going to go from here to here. And you know what methodology will give you that context? I mean, obviously it's going to be Elliott wave, right? Here's a specific example in the NASDAQ doing a spread, doing a butterfly spread. All right, this was back on September 14th, 2018. NASDAQ was moving up. I was kind of getting a little bearish on the market, looking for this drop. And there's a way you can safely kind of reduce the risk that you'd have to put out there to try to call a difficult turning point in the market like this right here, like this big decline. So here's the trade that we put out there. On September 17th, we did this butterfly. We paid $345 for it. And basically, that's all you could risk, $345 in this trade. We took profits on September 10th and September 11th at $5.35 and $8.38. I mean, if you think about it, buying a stock at $345 and selling it for $535 and $838, pretty good percent return, right? But I did it with, I don't know, 20 or 30 contracts in the NDX, and this is the actual trade that we had on, right? So you could calculate the entire thing. The whole trade, cost just about $2,000 to $3,000 that I put out there, and I wound up making just under $9,000 in profit. This is all I could risk on the trade, but I would never even let it go to max risk. I probably had $2,000 of max potential loss in the trade, but I made $9,000 in the trade, and that was a highly difficult move of trying to call the top of a pretty sharp rally in the NASDAQ. Luckily, it worked. If it didn't work, I would have taken my loss and would have been completely comfortable with it, but instead this one worked. All the trades don't work like this, I can promise you that. But the effective use of options, when you learn how to do it, you can get these kind of trades that go 2,000 of risk to 9,000 in return. I mean, we've done it. I can't do it every day. I wish I could. I'd be a multi-billionaire, and I'd bring you guys all into the service for free. But we work hard for these trades, right? So if you master the now, the future will take care of itself. I think you have to realize, just like Doc Brown says in the Back to the Future, no one's future is written. I think the future is unwritten. Anything can happen tomorrow in the markets, so just be completely prepared for anything. And that's what makes the markets so fun, is I don't think the future is written. So look for multiple possibilities. Keep your mind open. Be content with the idea that there are multiple wave counts that could happen in the future, because again, I don't think it's written. And I think you just have to master the now rather than worry about the future, because you can't control it. And that, for me, was my enlightenment with trading. Is I always said, oh my God, I have to figure out what's going to happen tomorrow. No, you have to be good at managing your process today, not tomorrow. And of course, all you guys out there, I'm sure, love this picture, right? But it's like enlightenment, all right, for me. Using the tools that we have, Elliott and Fib, we have an expected starting and stopping points of those trends and corrective waves. Rest easy. Trade with higher EQ, emotional intelligence, not IQ, which is intelligence up here, EQ, which is knowing that you can't know the future and I can't stress about it. Have the confidence that you're heading into a trade with a well-executed plan. As long as you execute the trade plan, you're good. You have nothing to stress about. I don't get pissed off if I get stopped out on a trade that I executed well. I do get pissed off if I lose money in a trade that I didn't plan out and I didn't go through the process, which I haven't done in years. I used to get really mad, and I just stopped doing that. So, guys, introducing, we have a course that we've been working on for a couple months now. It's called the Trading Analysis Crash Course, pun intended. All right, we're going to take you through all three pillars of our trading like we just did. I rushed through it. I'm trying to get you guys out of here inside of an hour. I said 45 minutes. We're at an hour. We kind of went back and forth for 7 or 8 minutes in the beginning. So we're at that 45-minute mark. So I've just given you a taste of what we do every single day here at Trading Analysis, and it's in this course. So we cover the strategies we use to capture those powerful stock and option moves, strategies that we use, including debit spreads, credit spreads, iron condors, butterflies, straddles, and strangles. Stop guessing and risking your valuable capital on substandard setups without any idea of what your trade plan is. So the course is the crash course. Is there going to be a crash in the future? Maybe, but we're going to crash you into life at Trading Analysis. So using Elliott Wave to identify when to deploy capital, how to trade your capital, how to construct stocks and options portfolios, intro to Elliott Wave analysis, motive versus corrective waves, as I touched on earlier, Fib thesis, history and application, how Fib can be applied to Elliott Wave. Fibonacci is very important. I think it goes together like peanut butter and jelly with Elliott. Intermarket analysis, which we touched on, and fundamentals. Option basics, including verticals, butterflies, diagonals. Risk management, the art of the trade, which is something we take very seriously, and the software we use for trading and analysis. All of this is included in the course. As a bonus time, when you buy the course, we're going to give you 3 months of the TA Premier service at a ridiculously low price. If you're not on, if you're on YouTube, check out this website, tradinganalysis.com/ride. What else am I supposed to say, Andy? If you're on YouTube, go to ride.
If you're on our page, you can scroll.
If you're on our page, you should be able to look directly below and see the link. Thank you very much. Let me show you what you get. Let me kind of sum that together before you click off the page. Within the Premier Alert and Analysis Service, okay, this is our bonus. We're offering you like an 8-hour course for a very competitive price, but as a bonus, you're getting 3 months of our service. So what does our service include? Come onto our trading desk as you watch us trade in real time. Walk you through step by step each correction of the major stock, commodity, crypto, and other markets. Get concise, clear trade alerts. When I make a trade with my live capital, a push notification goes out on our app that says I am buying here, I am selling here, this is my stop, this is my size, this is my conviction, and here's the exact option strategy I'm using. And detailed charts showing you exactly how we view the markets. That's all included in the service. The course, I mean, obviously you can tell we like to get into the technology. We use the technology, high def cameras and studio quality, audio and lighting to make high production value online e-learning course. And that's going to be a login access course on the Trade Analysis site that you'll have lifetime access to. So it's interactive, high def video, clear audio, studio quality, production value. Online e-learning is one of the fastest growing segments in the digital marketing space. And Trade Analysis was right at the forefront of that push, specifically in the trading industry. So this course is built up, ready for you to go and start consuming. The service, again, this is the service end of it. After you get through the course, maybe it's a good idea if you actually get the course and put your service on hold. Sorry, Andy, I'm making extra work for you and the team, but maybe you go through the course and then put the service on hold, then take your 3 months. It might be a good idea. We have it in the stock, we have it in the Forex, and we have it in the crypto markets. Okay. As a bonus, every Wednesday we get together, we do a live webinar. I put on live trades this morning. I can show you a few of those trades. We interact, we go back and forth, much like we do right here. So that's a live trading webinar every Wednesday. If you can't ever attend, everything is recorded. Okay. So here's what you get. All right. Number one. Hold on. Okay. Full access to the Trading Analysis Crash Course. That is valued at $430. Just buying the course. $430. You get 3 months of the Premier membership. On top of that, that's a totally separate part of the offer, which includes our live trade alerts via our mobile app, which is right here. Daily member videos. Each video is anywhere from 10 to 20 minutes as I take you through all of our positions, show you where we are in the markets, talk about relevant topics, whatever's happening in the markets. You get the weekly live member webinar, full access to the chart room, full access to the trade desk, which is a record of all trades that we've done over the last 3 or 4 years, everything that's open, everything that's closed, all the details. We have a portfolio of stocks that we carry and we track that performance. That is all worth $531. So together, the retail is at $961 for the course and 3 months of our service. Today, what we're doing, this is part 2. This is the ENCORE webinar. We're slashing it. I mean, that's 50%, give or take. So there'll be that's a 50% savings to $477 for both 3 months of the service, including push notifications and lifetime access to the course. Okay, this is, oh, I messed that up. Oops, sorry. Let me fix that real quick. This is going to come down, when does it come down? Sunday, it's over? All right, so it's going to be Sunday. What's that going to be? Give me a date. 29th. It's going to be 29th at midnight. Okay, so this offer is going to come off the site on the 29th. Okay, so go jump on that course if you're all interested. It's over a $900 value, 3 months of the course, 3 months of the subscription, lifetime access to the course, and I'll show you what the course looks like. for half price, $477. Okay. So there we go. And Sunday, September 29th, the 18th was the first presentation we did. This is the ENCORE, tradinganalysis.com/ride. You get push notification, trade alerts, weekly, daily videos, access to our trade desk, access to our chart room, and our private Facebook group. All right, let me pull Terry in here. Terry, you with me?
I didn't fall asleep.
Oh, I'm sorry to keep you up so late.
Oh no, it's much later for you. I'm an hour earlier.
I know.
We got some good questions out there too. Maybe you can, while people are looking at the offer and considering it, why don't we answer a few more of these questions here?
Sure. Let's take a look here. And in fact, I wanted to show them the course too. So it's definitely options for beginners as well. We'll take you through right from the beginning and kind of build you up. So there's our website, tradinganalysis.com. You go to the login page. Mine's going to look a little different because I'm an admin. Get out of there. And then
we do have a few members, or a few viewers tonight that says they're using Elliott Wave. Kudos to you guys.
Very good.
You feel confident in your Elliott Wave trading, or would you like to improve it? We can help you do that too. So
Exactly. This is the actual course. These are all the courses that we have, but the crash course is right on top there. And this is what it actually looks like. Welcome to TA, Trading Your Capital, Elliott Wave techniques, fib, intermarket analysis, options, risk management, software use, and how to utilize the TA membership. So overall, it's about eight hours of content, and all of the team at Trading Analysis contributed. This is Terry's section right there. So it's a full offering, and this is what it actually looks like. And you can mark each section complete, track your progress, and
yeah, those are full-length videos. Those they're given from a slide deck, but it's a well-produced video.
Yep. And I'll even see if I can go full page here.
The nice thing about having a video right there on your computer, you can pause it, rewind it, go back, take your own notes, watch it as many times you can, watch as much as you want, come back later if you feel like you've absorbed too much, too fast, go back, look at it again, and hopefully we're a little bit entertaining in there too. So
we try to be. We try to have some fun with it, right?
Absolutely.
So let me just throw some questions. Can you? I'm just making a quick adjustment on this slide because that one desktop froze. Any questions you can address in there, Terry?
Well, here's a question from Ziad. Todd, what course do you recommend for someone who knows in general about options, has the TOS platform, but never traded options?
I mean,
we have enough content in this course to get you going with options, and then we also have more advanced option trading courses available.
Yeah, absolutely. I mean, if you have the TOS platform, which is Thinkorswim, and you just don't have the confidence yet to trade, maybe the methodology or your game plan isn't dialed in enough. And this is kind of a holistic approach to what we do. I really believe that this might be the course for you to just kind of get rooted and have a concrete daily approach to how you trade. You got to have the confidence to put that first trade on. I highly recommend this because not only this course, but you're getting 3 months you're watching us do it, and we explain the trades all the time. There's 8 people on the team. We've got tons of members around the world that are constantly interacting, and you get to watch us go through it every single day. I would definitely recommend this course. So yeah, I mean, there's just no question about it.
Got a question from Cindy.
See you, boys.
She posted this earlier on. So when you talk about butterflies, can you tell us how you choose between calls or puts?
Great question. That's Cindy. It doesn't matter. It's crazy to think about, Cindy. If you think the market's going to, okay, so let me make an example for you here. So this is the TLT.
We're going to talk about balanced butterflies.
Yeah, it still doesn't even matter.
Yeah, I know.
It
I
doesn't.
always hit you up with that.
That's all right. So if you wanted to do a butterfly, so let's say we were going to do, let's just do like a 140 on the put side. Let's do 140 even buy butterfly. 140 to 145 to 135. So we're trying to get TLT to stay right around 140 to 145. If you go analyze trade, here we go. See how it's, look at this teal number over here, $150 of risk on either side to make 339. If you just simply switch this to calls, it's the exact same thing, 150 to make 350 against 150. It's the exact same thing. You're seeing a slight difference just because the bid-ask spread's a little different, but it doesn't matter if you do puts or calls. I generally think puts have...
Does it change that skew a little bit depending upon the market conviction, whether you're using puts or calls?
There will, right? Deeper puts will have a bigger skew. That's a good point. There's more volatile extrinsic value put into puts because of the vol skew, but for at the money, for the most part, it really doesn't matter that much.
Near-term options, at the money options. We're
Yep.
not talking leaps and things like that.
Yeah. Michael, what was it? Michael M, what trade you asked about duration of the trade, and you say some of the best traders in the world have a win-loss ratio in the low 40s. You're 100% right by that. 100% right by that. So give me more info there. If there's a lag on toss, James, try increasing the memory you allocate towards it. I've been fine with it. You can change that when you launch it up. So again, this is the course. I'm going to definitely go back and answer more questions. And then here's the members area, TA Premier. This is the dashboard for trading analysis. So chart room, strategy videos, members webinar, TA Trade Desk, the Facebook group, our portfolio. We have Elliott Wave in the cloud on the software we use. So as we make Elliott Wave changes on our software, it updates on your software. That's not included in this, in Traders Classroom. So, and there's the app. So this is all part of, what we're offering here for you. You're getting a 2-for-1 here tonight, guys. So definitely go do it. It's tradinganalysis.com/ride, which should take you to this. Oops, that's not right. Tradinganalysis.com. If I can type, analysis.com/ride.
We only type that about 100 times a day. So
I know.
You'd think your fingers would have that muscle memory embedded, but they never do.
You get nervous typing in front of lots of people, right? So that's the offer, $477. You can get it now at tradinganalysis.com/ride.
The 3 months worth of membership. Even if you were just paying it for that, it's just to get this.
Just to get the quarterly. It's basically quarter membership, and you get a $500 course for free.
Absolutely.
It's too good. All right, so that's that. Let me check other questions, and I'll pull some charts if you guys want me to look at some markets.
What other requirements are needed for the crash course? No, you don't need TOS.
Nope. Just a willingness to learn.
Not a requirement. TOS, we use TOS because we love the Thinkorswim interface, and because we are trading options, it's got a great options platform. But you can use any broker that you've got. There's, and matter of fact, we have many members using other brokerage firms.
Okay, got it. Yeah, 100%. And then Michael M, just email me. I'll give you my email here. Just email me. Let's connect. Todd at Trading Analysis. I'm downtown right now, Michael. So yeah, just email me. We'll connect. I got a guy right here in Saratoga. That's great. So other questions. Repo market is not having too much. I think the Fed's addressing these short-term liquidity overnight concerns. I don't think it's having too much of an issue. Market's more driven by politics right now, and obviously price patterns. And here's a couple of trades we have on right now. This is an earnings trade that we're going through right now, which is Nike. Let's get off the SP and go Nike. So this was a really nice one. We put the trade on back here in Nike. I'll show you the exact trade. It was a butterfly that we put on for earnings, which I like to do to kind of minimize risk. It makes it a little harder to make money, but it works fairly well in terms of containing risk. So here's Nike. We've got an 85.90.95 call butterfly on. I have 4x8x4 contracts. If you look at the Analyze tab on Nike, we wanted to settle somewhere around the 89 to 91 mark. The trade went on, if I just right-click and view trades, it went on right here on, I don't know if you can see this. See if I can pull this up a little bit. The trade went on August 28th. Okay, August 28th is right here, coming out of this triangle consolidation in Nike. I thought the triangle was over, so we did an 85, 90, 95 call butterfly. Now, why would we sell the 95 call on the upside? Well, we have, see these four levels of fib resistance up here from 94 to 96. This is where I think, the market, when we were back here on the 28th, it's like if earnings are good, we should move up. But I don't think we're going to go above the 95 area. So that's why we did an 85. We bought one, sold two at 90, which is right where the earnings kind of came out, but we went a little higher, which is okay. And then we sold the 95s. That is all an Elliott wave count, knowing that this is likely wave 4, probably going to have one more push in wave 5. And if we could get the market to close close to 90, which we have good reason to think so because we're following the Elliott model, we have fib up here, it's a good way to trade earnings. And they don't always work this way. But again, if we go over here, I had $400 of risk on either side. Max profit would be just about $1,600. Right now, we're at 1,054 in profits. Right now, 1,058. And if we could finish there Friday, possibly 1,200. And if we could back off a little bit, maybe 1,600. Right? So that's a good live trade that we have on. I also have the trade on in our longer term RIA accounts with McDonald's. No, right there. Nike right there. Okay. So this is a live $100,000 account that I trade for. Just kind of the portfolio aspect of this service, live capital. Okay, so that's just kind of a combination. That's an idea of pulling everything together. Consumer discretionary has been strong, Nike's been strong, we're in a good Elliott position, earnings were coming out, reported earnings, we have an idea of where it might go. Earnings can be unpredictable, so if it doesn't happen and we're completely wrong, my risk is defined. I have $400 of risk, that's it. That's fine, and I might make, if things work out, maybe $1,200, $1,500. It doesn't happen all the time, I can promise you that, but I can teach you how we did this trade. What other questions? So, Michael, again, please address people's possible concerns regarding the objectivity of Elliott wave. Multiple interpretations can be derived from the same pattern. I love it. It's a great question. We address it all the time, and I just don't think that you take a set of data, and from a set of data which is produced by the collective activities of a bunch of emotional people, and say the crowd operating on fear and greed based on all the past occurrences, this is going to be the patterns they form. This is going to be their next move. I mean, can you put 1,000 people in a room and give them a set of, goals to accomplish collectively? And, what are they, let's say, you set a fifth goal. Can you tell me how they're going to achieve that goal? You can have an idea of how they've achieved past goals and accomplished past activities. But, the next one, I understand what they've done in the past, but they still could do multiple, take multiple choices, take multiple paths, make multiple choices, have variations of what they've done in the past in order to accomplish that goal. I don't think it's wrong to say, the crowd could accomplish it this way, they could accomplish it this way. I think this is ultimately the goal, what they're going to arrive, the solution they're going to arrive at, but I can't tell you the path they're going to follow precisely. And I'm personally good with that because you're quite literally trying to foretell the future. So that's all you're doing with Elliott is you're looking at price patterns and what the collective masses have done in the past in order to move price to a certain point and say, well, this is what they could do in the future. And I look at multiple possibilities of paths they could follow, and I'm completely fine with that. If I'm sitting here selling you a methodology that says, here's your formulaic approach to get rich, next week, I think you should turn this video off. And if you ever get in front of a sales presentation where somebody's telling you this is your path forward, this is how you foretell the future, I think you should run. So I not only don't hide from the subjectivity, I embrace it. I think we know that forecasting the future is imperfect, but what I love about Elliott is there's points of ruin in each interpretation. If those points of ruin are reached, then we know this scenario is not correct and we need to contain the risk and move on. So I love it that there's multiple possibilities. If somebody's trying to sell me a system that's formulaic to make money, God, I'm a lost soul. I am a poor lost soul who's got no chance. Anything to add, Terry?
No, let's see. Ziad's got a question.
Yep.
About gold-silver ratio.
Sure. It wasn't working early. It might take me a second to set it up. Sometimes when I transfer over to this computer, this is our kind of presentation computer. My main trading computer's over there, so sometimes it doesn't translate over perfectly, but I can...
Some other analysts have been making some really crazy high forecasts of gold lately. Then what do we say to that?
I'll show you where we are, and I just got to rebuild it quickly. And where we might go, that should work. There we go. So gold silver is interesting. I had it in the presentation. I took it out just in the interest of time. So my data, unfortunately, only goes back to 2002 on this particular chart. There's obviously a lot more historical data of gold silver. But what we're talking about here, guys, is the historical ratio of gold into silver. And since the turn of the century...
Can you make that bigger, Todd?
Oh, yeah.
Did you do this in... yeah, you did this with your IQ data. I thought you had more data there.
Yeah, for some reason, it's only going back to 2001, which is annoying. So if gold gets to the point where it's 80 times the price of silver, that's viewed to be gold overbought, silver undersold, oversold, I should say. Gold is too expensive relative to silver. 80 has been the stopping point in 2003, in 2008, 2014, 2015, 2018, but look what we just did. Holy bananas. We just broke through resistance, and now we're testing support. So I don't know. I mean, I think that's pretty telling. If we hold the 80 level, 85, and we start going bid again, maybe you just stick with gold over silver. I was of the view that we're overbought in gold, silver, and silver should outperform gold as the ratio mean reverts. But I mean, that's a pretty strong move right there. And you could go back, obviously, decades to look at this ratio. That's a historically very overbought gold to silver ratio. So I mean, I'll show you my gold rate, gold count if you want. But if we get back below 80, then I think you could be short gold, long silver, which is a bullish stock market relationship. If silver gains are outpacing that of gold, generally the S&P is going up. If the gold market is outpacing the silver market, the stock market is going down. That's an old historical relationship on Wall Street. Hasn't been the case in the era of QE, quantitative easing, where the bonds are being bought up by central banks, driving gold up faster than silver, because they are a little bit more correlated. Bonds and gold are more correlated, so central banks have been bidding up bonds, pushing gold up, which has thrown that ratio out of whack. So is the relationship not valid anymore? I don't know, but you certainly want to watch around the 80 mark. Does that help? Not including Peter Schiff, yeah. So guys, let me just tell you again who is taking advantage of the offer, who's coming on board the volatility wave with us. Let me just go over the offer again. So again, it's full access to the high-def course, e-learning crash course, lifetime access, $430 course, 3 months of the premier membership, which includes the live trade alerts, which when we make a trade, we made several trades today, it goes out on push notification. You get them instantly with explicit instructions what to do. You get daily members video, 10 to 15 to 20-minute video of our positions, what we're looking to do. You get the weekly live members webinar. You get the full access to the chart room, full access to the trade desk, which is a record of all trades that we have open. That's valued at $531. Grand value, just under $1,000. And we're going to cut it in half and give it to you for $477. The way you take advantage of that is go to tradinganalysis.com/ride if you're not already there. If you are there, you should be able to look below and get the course and get the access to the 3 months. We'll take this down Sunday, September 29th at 11:59 EST. Okay, so that's the offer. Ziad, awesome. That's great. Appreciate it. Any other questions, comments?
Miguel has a question. TNX, please, and why? Explain why you think the S&P is already forming a triangle and not an ABC correction. And this is what we talked about with our members this morning.
Are you talking about TNX 10-year yield or the S&P or both? He's asking both.
He's asking for both.
Okay. All right, where's his question? So, one more time. Break it. So first,
9:17 p.m.
I don't have timestamps.
You don't? Okay. He's asking to show the TNX again. And
Okay.
then the second question is why we think the S&P is already forming a triangle and not an ABC.
Okay. All right, got
We
it.
can start with the second question here first.
So is the ABC, do you think he's talking about going up, Terry? ABC up?
Why do we have this in a triangle? Yes.
Okay, the big, all right. Well, if I'm answering the right triangle, okay. I think, let's take the first possibility from September 2018. Most simply, it's 3 down, and so far it's been 3 up. I don't, it could be that we're going to fall into a flat, which means we're going to have a sharp 5-wave decline. It's possible. But I think, after this move that we've seen, this long move that we've seen, I think a sideways consolidation, because I think that's more likely. I'm seeing much more stocks that are falling into triangles. A lot of the oil stocks are. Intel is. It's possible Apple is. Google's in a triangle. There's a lot of triangles out there in the market, which means that we're not going to fall in 5 waves or sharply in C. We could just do a 3-wave move. And then we do another 3 in D and another 3 in E. And that consolidation takes us into 2020. I could be wrong. And the other possibility is, before I move on, the outlook is up to this area here in the S&P count. The other possibility is consolidation's over. Wave 4 is over, and we're already rallying in the next impulsive move. And we're about to go significantly higher. That's a possibility. I don't think likely, but possible. I don't know. I can't foretell the future. But everything that we have right now indicates that we should go from here to at least here. And if we continue to move up, then it's likely going to be this wave count here, right? So I don't know what the future holds, but I think everything that I'm pointing to does continue to suggest we go at least up to 32 to 3,300, and that's the way we're positioning.
I do talk about this in the Elliott Wave course a little bit when we're talking about triangles and corrections in flats. Because there is a point in the triangle where you cannot tell, you're too early. You cannot tell that it will resolve itself into a triangle, because it still could resolve itself into a flat instead.
Yep.
And I think we're in that time period right now where we are waiting, and it's one of the reasons we're sitting with so much cash in the sidelines and hesitant to put too much at play, is we're waiting for the market to show its hand and give us clarity based on using the rules of Elliott Wave to map out our patterns. We've got a clear set of guidelines. Like Todd said, all of those wave counts are valid. Now, what we monitor them for is for violation of any of the Elliott Wave rules or Fibonacci support and resistance levels, which you'll also learn about in the course. So by looking at these key levels and the fib levels and these key reversal patterns in Elliott Wave, we gain ourselves more market conviction, and then we have a higher probability of winning trades when we do put our trades on. So I hope that helps explain it a little bit, and I think you'll get that out of the course for sure.
I couldn't have said it better, Terry. Really well put.
Thank you. Well, you know, I'm just as passionate about this stuff, maybe not quite as much as you, Todd, but I certainly am very passionate about this, and I appreciate you were my mentor. You were my teacher, and it's just, you know, an honor for me to be able to pass this training on to other generations. This is the same kind of thing I did as an engineer throughout my years in the organization. I learned from those with more experience, and when I got to the point in my career when I had more experience, I passed that on to those coming behind me with the full explanation or expectation that they would be just as successful or more than me in their ventures. And I have that same feeling here with this,
I appreciate
this service.
I've got several successful customers like Terry. Terry's very accomplished in his corporate life. Hopefully you don't mind me saying that. And you know, this is his retirement job. You know, they call him in to help every now and then, but he works hard, and I'm lucky to have him on the team. But we have a good amount of customers who are very successful in their own careers and have joined up, and I've had the pleasure of meeting a lot of good people. So hopefully you guys want to join the community. We're not cult-like. We're just guys who really enjoy this process, the intellectual pursuit of trying to foretell the future, which you know you really can't do. You just have to be able to control the now and define your process. And it's the constant, you know, application, repetition of your process that, one, you have to define, and two, you have to do multiple times in order to trade well. So
you know, you left something out up there. I'm looking at that slide. There's another benefit to being in subscriber.
Wait, what?
Is our member forum that we have.
Our member forum.
So not only do you get daily video updates from Todd, but 24 hours a day we have an active Facebook group in each of our premier blockchain and Forex groups where other members can mentor you. They can help answer the question. You can ask questions, pose it out there to our other subscribers.
And it is an active group. Holy cow. Talking about Nike, 7 hours. Oh, there we go, Dimitri. The webinar quality was great. Oh, awesome. My voice sounds way worse than Jelly. Yeah, this is better.
I think you changed your microphone. I think the microphone you're using now he likes, and the one you used for the daily video was or the
Oh,
webinar
man.
today was less. So it may get you to keep this mic you got on. I like it.
All right. But this is,
But anyway, yeah, I just wanted to add to that. I saw that wasn't, that, so
it wasn't
it's
there.
not,
I
if you
can't
can't
believe
get
it.
enough of Todd, with Todd's busy schedule, look, there we are. There's our minions. Give our newest members a warm welcome. We love you guys. And we're here for you. So, here's a
Look at
member
all,
posting one of his charts.
I mean, there was, there's 20 posts and comments in the last day or two. Like, this is,
Yeah.
it's an active group.
Yeah, we do our best. We like to let our members try to help other members out. We have a good help service. We talk about our buddy Nick. Give him a cue. Our head of customer support.
Customer support.
He does a yeoman's job dealing behind the scenes, keeping everybody happy with their membership. Tristan, talk about Tristan for a minute. He's our webmaster. Design expert. He was telling, I think he posted something about we're going to be updating our website again with some new features. So we try to keep it interesting and active.
Wait, hold on. Don't give the whole, I'm trying to, I've got so many windows open. I've lost my, the presentation so I could show pictures of, oh man, I'm terrible at this. Sorry. Oh, here we go.
That's all right.
Here we go. Let me go right to the top here. Show you the team again. I'm very proud of the team. The guys who've, oh man, they've done such a good job. And everyone's here to serve you guys. We take the community very seriously. There's Alex, just as passionate and just as good as Elliott Wave. There's Terry. Nick, great at customer service. You'll find if you speak to him.
He just got married.
He just got married,
week,
exactly.
So he's a newlywed, yeah.
Yeah. What was he thinking? No, just kidding. And he's my COO. He was here with his brother, and they're out, I think, in Saratoga causing some trouble, which I might cause just a little bit of here in a little bit. Maybe go out and meet the boys. I think my wife is already in bed, so free pass. Don't tell anybody. Or tell my mom. There's Tristan right there. He's great behind the scenes and on the website. And, we have even another guy who does our graphic design. So we have a good team. Proud of the team. They make it all possible. So, guys, that's the offer.
We don't have a picture of Joel.
Yeah, we need Joel up there.
We need a picture. We had a picture of Joel.
I know. I got to put it in the
presentation. We don't have it on that
presentation.
slide. Yeah, we got it on another presentation. But yeah, we got a global team here, and we can cover all of this in addition to the stocks. And like I said, we've got Forex and blockchain.
See?
And it's 24 hours, 24/7 on blockchain. You know that, guys. So.
Yep, there's Facebook right there. And if you want to cancel at any time, there's a cancellation option right there. In the members area, you can just cancel it off. And that's about it, guys. So come on in. tradinganalysis.com/ride. 3 months, lifetime access to a course that is easily worth that. And we'd love to have you. All right. So, guys, we're going to leave it there. Terry, thanks so much. Everyone, thanks for attending. I very much appreciate it. Love to have you guys on the team. If not, hopefully we catch you another time. If this is not right for you, best of luck in the future. I truly hope you find something that resonates for you, because that's the most important thing, that you find a community, find a methodology that works for you, because when things really get moving, you gotta have everything dialed in. So I wish you best of luck. If you don't continue on with us, hope you find what is going to help you. Honestly, best luck in the future. I hope all the best for you guys and members. We'll see you tomorrow morning. Terry, I'll see you. Thanks for a hard day's work. I do appreciate it.
Thank you, Todd. Hope to see you guys soon.
All right. See you guys. Take care.